Brad Williams, Frugal Finance. I'm going to throw some math at you. We're going to look at some standard deviation stuff and what have you. Hopefully I won't lose you, but if I do, go back, reread this. Just keep rereading it. Work out the numbers. Just work through these simple formulas. What are we looking at? Risk minimization hedging. What does that mean? In our first example, we consider hedges when the hedger had a definite horizon in view. Often the hedger will not want to hedge for a specific future date. Instead, the hedger may wait to control a continuing risk on an indefinite basis. Consider, for example, a soy dealer who holds an inventory of soybeans. From this inventory, the dealer meets orders from her customers. As her inventory becomes low, she periodically replenishes her own inventory from cash market sources. The inventory that she holds will fluctuate in value with the price of future contracts. As the following case study shows, figure 4.3 shows 300 days of historical soybean cash prices. We assume that the present is day 60 and soybeans are near their recent high, closing today at 719.5 cents per bushel. As figure 4.3 shows, soybeans have been quite volatile, and what we're looking at here is this right here. We have this hedge, we have this unhedged deal. We have dollar in days. We're going to go back up here. As figure 4.3 shows, soybeans have been quite volatile in the preceding 60 days. Therefore, the dealer decides to hedge her inventory of 1 million bushels of soybeans by selling soybean futures. After she sells futures, she'll be long the physical soybeans in her inventory and short soybean futures. Think about that. Why is she long the commodity and short the futures? If the hedge works, the risk of the combined cash futures position should be less than the cash position alone. With an inventory of 1 million bushels and a soybean contract calling for 5,000 bushels, it might seem wise to sell 1 bushel in the futures market for each bushel in the cash market. This would call for selling 200 soybean contracts. However, a 1-to-1 hedge may not be optimal. In our example, the dealer wants to minimize her pre-existing risk, which comes from holding her soybean inventory. We assume that she holds a given bean inventory for business reasons, and we treat that inventory decision as fixed. The dealer's problem is to choose the number of futures contracts that will minimize her risk. Thus, we define the hedge ratio as the number of futures contracts to hold for a given position in the commodity. We have HR, head ratio, equals negative futures position divided by cash market position. The dealer who trades hedge ratio units of the futures to establish the futures market hedge. The dealer will trade HR units of the futures to establish the futures market hedge. After establishing the hedge, the trader has a portfolio P that consists of the spot position plus the futures position. The profit and losses on the portfolio for one day will be PT plus 1 minus PT is equal to ST1 minus ST plus HR, etc., etc. Okay, you can read this, pretty self-explanatory. Note that in our initial discussion, we considered that the dealer might hedge each bushel in cash with 1 bushel of futures. In that case, the hedge ratio would be -1. The negative sign indicates a short position. Generally, if the trader is long the cash commodity, the futures position will be short. Likewise, if the trader is short the cash good, the futures position will be long. Think about that. Why is that the general rule? Think for a second. Does this position actually represent the commodity? In the long position, the soybean person is holding the soybean, so yeah. Now, however, the dealer wants to choose the hedge ratio that will minimize the risk of the portfolio of the spot beans in the futures position. The variance of the combined position depends on the variance of the cash price. We went through this earlier where we determined the covariance. So the variance of the futures price and the covariance between the two prices. It is a basic statistical rule that the variance of returns on a portfolio P of 1 unit of the spot asset and HR units of future contract is given by the following equation. We went through this, and P looks like is the variance of S of T, the variance of F of 2. Looks like P of S of S is the correlation between S of T and F of T. The dealer minimizes the variance by choosing a hedge ratio as follows, where this right here is the covariance between S and F. As a practical matter, the easiest way to find the risk minimizing hedge ratio is to estimate the following regression. This, where sigma is the constant regression parameter, beta is the slope regression parameter, and E is an error term with zero mean and standard deviation of 1.0. The negative of the estimated beta from the regression is the risk minimizing hedge ratio, because the estimated beta equals the sample variance between the independent F of T and dependent variables divided by the minimizing hedge ratio in equation 4.4. From this regression estimation, we also obtain a measure of hedging effectiveness. The coefficient of determination, or R squared, provided by the regression estimate. Conceptually, R of 2, coefficient of determination, portion of total variance is the cash price change statistically related to the future price changes. Thus, the R2 will always be a number between 0 and 1. Closer it is to 1, the better will be the degree of fit in the regression between the cash and futures, and the better will be the chance of our hedge working. There has been considerable controversy regarding the proper measure. While this controversy is not fully resolved, we recommend using the change in price or the percentage change in price, but not the price level. If the general range of price over the estimation period is fairly stable, the price change measure will be satisfactory. If, on the other hand, the price changes dramatically, the use of percentage price changes will give better results. We now apply the regression approach to the problem of our soybean dealer, using the immediate previous 60-day data to estimate the following regression equation. Here, where the change in S of T is the cash price on day T, and the change in F of T is the change in the futures price on day T. Estimating the regression gives the following parameter estimates. Alpha equals 0.69, beta is equal to 8713, R squared is equal to 0.56. Estimated beta at 0.8713, the model suggests selling 0.8713 bushels in the futures market with 1 million bushels in inventory and a futures contract of 5,000 bushels. The model suggests selling 174 contracts because 0.813 times 1 million divided by 5,000 equals 174.26. From the estimation of the model, we see that the regression accounts for 56% of the variance of the cash price change during our sample period. This is an important point because the regression chose an estimate of beta to maximize R squared. This provides no certainty that we can expect similar results beyond the estimation period. To this point, in our example, we have used the data that would actually be available to a trader on day 60. We assume that our soybean dealer estimated her hedge ratio and placed the hedge at the close of the next business day. Next, we will want to evaluate the performance of the hedge. Figure 4.4 shows how soybeans perform from day 61 through day 300. Approximately over the next year, when we assume that the dealer offset in the futures market, thereby ending the hedge. The graph in 4.4 shows the wealth change from day 61 onward for one contract of cash soybeans, and for a contract, 5,000 bushels of cash soybeans hedged. 8713, as the figure shows, soybean prices fell dramatically over the next year. From the time the hedge was placed until about day 150, soybean prices fell about $2 per bushel. During the same interval, the hedge position lost about $1 per bushel. From about day 150 to 300, price drifted somewhat higher. Comparing the hedge and the hedge strategies, we see that both lost money. However, the hedge strategy avoided about 50% of the loss associated with the drop in cash prices. Over the life of the hedge, unhedged bushel of soybeans lost $1.56 and the hedged bushel lost 71 cents. On the inventory of 1 million bushels, this represents a benefit of $850,000 from hedging. From 4.4, we can also see that the hedge position has much less variance than the cash position. For an unhedged bushel, the standard deviation of the price change was 0.085 per day. For the hedge position, the standard deviation was 0.0431. Several special points need to be made about this particular hedge. First, we see that the hedge made money because the short position in the futures gave profit as soybean prices fell. We must realize that bean prices could just as easily have risen. In that event, the future position in the hedge would have lost money. This brings us to the second point. Hedging aims at reducing risk, not generating profits. In this case, the goal was to reduce variance and would have been successful in attaining its goal. Thus, the hedger must expect an equal chance of monetary gains and losses from placing a hedge. However, a good hedge, the variance does not reduce substantially in terms of volatility in the days. Go back, reread this. If you're finding weakness in understanding variance and covariance and standard deviation, go back and bust open a statistics book, spend $3 and buy a used statistics books and just take a look and just brush up. Otherwise, do a few calculations and make up a couple hypotheticals and come up with your own scenario. Brad Williams, Frugal Finance. Thanks for watching.